Hey, what's up, stock compounders? Brad here. So we have another Q&A from Mohnish Pabrai, this time at Harvard Business School. This Q&A happened on April 3rd. Okay, so we're about a month out. But in this video, Pabrai drops the news that he's completely out of Seritage Growth Properties. And he gives his rationale for that. And I will get to that. But first, I'm going to share kind of my highlights in this talk, as always. So let's jump right in. First, he says the father of value investing was Ben Graham, okay? And Ben Graham led us astray. Now, clearly, Ben Graham gave us many very valuable things as investors, right? But the one way that Ben Graham really led us astray, at least according to Mohnish Pabrai, is that his focus was to buy at, say, 40 or 50 cents on the dollar and sell at $1. It's that selling at $1 that Pabrai thinks led us astray. In investing, you make the most money buying companies that have a long runway. You shouldn't be selling even when the price goes above the intrinsic value, okay? And what Pabrai is really getting at here is probably not enough attention is paid to the tax consequences of selling. Also, when you sell a company, if it goes above intrinsic value, you've got to buy something else, right? And you're not going to know that thing as well as this business that you've owned, hopefully for many years. Well, hopefully not that long if you bought it at 50 cents and you sold when it went to $1. But it's a much tougher game in some ways to buy a 50-cent dollar bill and then have to go and find another 50-cent dollar bill, right? It's kind of constant action. And the more action we take, the more chances are for us to make mistakes, right? So, Pabrai, at least he's totally shifted his framework from buying 50-cent dollar bills to now really trying to find these businesses, great businesses that have long-term competitive advantages that can grow the business over decades, right? Really just plop the money down on that wagon that's going to ride off into the sunset and compound that capital at an impressive rate for many, many years to come. So that's really what the shift has been. Pabrai said, I have been a value investor which encompasses growth since 1994, okay, when Pabrai started investing his own money. And he's really pointing to value and growth. They're really attached at the hip, right? In order to determine what something is worth, what is the value of this business? You've got to factor in the growth, right? You've got to discount those cash flows, those future cash flows back to today to figure out, okay, what do I think this thing is worth? And then pay less than that, right? That's the value, that margin of safety, paying less than what you think something is worth. So he's been a value investor this whole time, right? 28 years. The change was being willing to hold things once they got above the intrinsic value. And Graham did point to this. He said, you should buy stocks like you're buying an ownership stake in a business, okay? So if you think about it that way, if you think of yourself as a business owner when you buy a stock, you're probably not going to be selling once it hits intrinsic value, right? You're a business owner. You're in it for the long haul. And as long as you see the intrinsic value growing, you're very happy to stay on that particular train, right? Because a growing business over a long period of time, provided the business has great economics, you're going to do very well. So that's the big shift for Pabrai. Holding above perceived intrinsic value, especially when the runway is very long and the business is getting better, that's the important change. Okay, holding above perceived intrinsic value. And I'll bring in something that Pabrai said about Charlie Munger. Munger, has been asked, why aren't you selling Costco? Right? It seems like the prices are kind of in the nosebleed section. And Charlie says, yeah, I can't rationally justify why I'm not selling Costco, but I have no interest in selling Costco. He probably wouldn't be a buyer at these prices of Costco. But there's something in his wiring that really understands the value of buying and holding great businesses for a very long time. He's asked about macro versus micro in Turkey. He says, what my little brain does is it starts with a business. Okay. What does it look like 5, 10, 15 years from now? That business. There's a small sliver of businesses where, based on my circle of competence, I think I can figure out the trajectory with the 50 to 60% success rate. With that type of batting average, the results will be great. Okay, if you can, get half of your investments right, like you nailed the thesis on half of your investments, you're going to do incredibly well in this game. When I look at things in the U.S. currently, I cannot come up with things that are obvious investments that my little brain can understand. Okay, so Pabrai being humble here, and really speaking to the point that he has no ability to forecast what's happening in the macro environment. The best he can do is drill down into an individual company, right? A business, to try to get a sense, okay, can I, with reasonable degree of certainty, anticipate what this business is going to be doing 5, 10, 15 years from now? Is the competitive advantage, is the moat strong enough that I can kind of count on these cash flows moving forward, right? So that's the big change. So now we get into the Q&A portion. He's asked about his investing checklist. So Pabrai's checklist was created by looking at mistakes from great investors. I think he hired a team of interns to do this, to comb through where did great investors lose money, okay? And of those circumstances, those situations where great investors lost money on an investment, could it have been seen when the investment was made that this red flag was there, that there was this seed of loss that was already present in the investment that could have been, picked out before the investment was made? And so this is really how he created his checklist. What are all of the things that have tripped up great investors in the past? Why did investments not work, right? And there were 3 big categories, 3 big reasons that investments didn't work out. One was leverage, okay? Using too much debt to finance the company. 2 was misunderstanding of the competitive advantage. You thought there was a moat there. You thought there was some kind of durable competitive advantage. Turned out there wasn't. Okay, that was illusory. And the 3rd is around management. Okay, both the skill of management and the alignment of management with shareholders. Okay, so those kind of 2 aspects of management. So, making a checklist, really focusing on these 3 big categories. So you find a business, you think you know it pretty well, you think you're ready to make the investment. Having a checklist that walks through, okay, what are all the things I need to ask myself around leverage for this company, around a sustainable competitive advantage, around management, And for Pabrai, when he thinks he really has the investment thesis buttoned up for a company, he'll go through his checklist and he'll realize, hey, there's 10 more things I need to find out about this company before I can invest. And it might take a couple weeks, it might take a couple months for Pabrai to really get to the bottom of those answers. But once he does that, he feels very confident in the investment, that he's not missing something that's going to trip him up, cause him to lose money. Seritage Growth Properties, okay? We don't own Seritage anymore. So this was as of April 3rd. Pabrai is completely out of Seritage Growth Properties. We bought right when the pandemic was hitting in the second quarter of 2020. I think it was like May of 2020 when Pabrai bought. The stock had collapsed from over $30 per share. I think it had been hovering right around $40 per share for a while. So from there down to $6 per share. Okay, so huge collapse. And in some ways it makes sense, right? Seritage owns all of these Sears buildings, formerly that the Sears was the tenant of. And when the shutdown happened, nobody was going to retail stores anymore. So it was quite scary to be in that particular business at that time. But he says, I analyzed it and it looked really cheap and like there was very significant upside, because they were redeveloping all these old Sears spaces. Last year, I concluded that I had made a mistake in one part of the Seritage thesis. They're redeveloping all these properties, and they may as well be operating in 100 different countries. Okay, each municipality, each location where this Sears building is, this commercial real estate asset, has its own rules around zoning and rezoning and redevelopment, right? So there's no scale there. You've got to put a lot of effort into each location, and the lessons from one location aren't going to translate to another location. So it's quite a mess in terms of the battles that have to be fought in each separate location. So you've got however many properties Seritage owns. I think it's like 170 some odd properties. They didn't intend to redevelop all of those. A lot of those were just planned to be sold off to raise cash to actually be able to redevelop the premier assets. But that's a lot of different battles, right? And it takes so long to be dealing with, the zoning office in each of these different counties or municipalities. So I had underestimated how difficult moving that aircraft carrier with all those different geographies and battles was going to be. We had bought it so cheap that we still had a significant gain upon the sale. Okay, so this wasn't a loss, but the thing that really hurt in this situation was opportunity cost. Because if you go back to that pandemic, right, the first quarter, second quarter of 2020, there were a lot of things trading very cheaply. And so, getting a 20% gain over 2 years now isn't very good, considering what the other opportunities were that were available. But Pabrai says it's very important to be honest with yourself about your mistakes. And so Pabrai, he's owning up. He made a mistake. Okay, he underestimated how long it was going to take for these properties to be redeveloped and to be generating cash for the shareholders. So, he owned up to his mistake. Yeah, so that's Seritage. I own Seritage, by the way. Many of you know that. I have not sold any of my shares of Seritage. So, for what that's worth, none of this is investment advice. On shameless cloning, Pabrai says, I am a shameless cloner, and I think it would be quite foolhardy in the investment world to not ride on the shoulders of giants. A lot of smart people have done a lot of heavy lifting. To try to sit down and create everything by yourself, nobody is that smart. So this is a little bit different of a definition of cloning than, Pabrai has talked about in the past. Here he's really talking about, of course, we should learn from other great investors, right? Dead or alive. Learning from Ben Graham, learning from Buffett, learning from Charlie Munger. So that's kind of what he's speaking to here, it sounds like. Of course you're going to do that if you're an investor. So that's, I guess, part of shameless cloning. The thing I understand that I think Pabrai means by shameless cloning, when he's more commonly talking about it, is looking what are great investors buying. Okay, what have they bought in the last quarter when the 13F filings come out? Are those businesses within my circle of competence, right? Do I have any experience in those industries that those businesses are operating in? And can I reverse engineer why I think this great investor bought these companies? So that's more of how I think about shameless cloning, at least as far as Pabrai talks about it. If you're embracing cloning, you will get a massive edge on your fellow peers and humans. People will look down on it, and that's okay. We have no shame, right? We are the shameless cloners. So it's okay. People look down on it, that's fine. We're not in this business of investing, right, to get accolades from others, to be lifted on high by others. We're in this business to make money. And if the best way to do that is to bowl with bumpers and only look at opportunities that have already been through all of the filters of other great investors, then that's the smart thing to do. Okay, that's kind of a no-brainer way to go about it, at least from Pabrai's perspective and mine. He's asked about emerging managers. Are there kind of newer fund managers that we should be paying attention to, that we should be learning from? Josh Tarasoff is one that Pabrai has mentioned in the past. And Josh Tarasoff manages Greenlee Lane Capital Management. And you can see here what his positions are, at least as of the fourth quarter of 2021. Salesforce, Brookfield Asset Management, Spotify, Amazon, Trupanion, Netflix, Google, Peloton, and then Burford Capital is, a pretty negligible conviction, or at least size, in the portfolio. And then here you can see, well, what did Josh do in the fourth quarter? Well, for a lot of positions, he added about 5%. Okay, that's kind of interesting. Trupanion, he slashed pretty good, reduced that position by 41%. And then you can see there are two new additions down here. The one that caught my attention was Peloton, because that's actually a sizable new addition at almost 9% of the portfolio. And Peloton has just gotten hammered recently. I think, the previous CEO stepped down. There's a new CEO, which is always, a little uncertain, right, about how that's going to play out with a new CEO. But the price has just gotten hammered, so could be getting interesting at this price. I don't own a Peloton. I've never used it, so this one's outside of my circle of competence, quite clearly. But, could be interesting for all of you Peloton bulls, at least. If you've ever been bullish on Peloton in the past, this is a particularly intriguing time to be looking at it, at least based on the price. And then he mentions Andrew Wilkinson of Tiny Capital. And I had no idea Wilkinson was on Pabrai's radar. I've watched a few things from Wilkinson before. I think he talks about having, like, what does he say? Like the e-commerce Berkshire Hathaway, something like that. It sounds like at least WeCommerce is the public company that Andrew Wilkinson is involved in. And that's different than Tiny Capital. I'm not as familiar with Tiny Capital. And I don't think there's any way for us to invest in Tiny Capital. I'm pretty sure it's not public. But I guess he's a guy that Pabrai is learning from, at least in the technology space. So, and of course, Pabrai has mentioned Rob Vinal in the past as well with RV Capital Management in Switzerland. So those are three guys to kind of dig into if you're looking to learn from some younger fund managers. There could be some great lessons there. So and then I was asked in the comments what I thought of the moderator, this Harvard Business School professor. There were people who were quite offended by her approach to this Q&A session. I didn't have an issue with her, quite frankly. Yeah, she could have done a lot more work up front. She could have kind of watched some of Pabrai's videos in the past. Clearly, she didn't do that. And she was also a bit opinionated at times, right? Not the smoothest operator, but I thought her kind of commanding more of the space in this Q&A and inserting some of her personal opinions into it made it a little bit more dynamic. I actually enjoyed that more so, than someone asking a quick question and then letting Pabrai talk for 5 minutes without much back and forth. So I enjoyed this particular style of interviewing. I can see why it would put a lot of people off, but it's just me. It worked for me. I found it a little bit more energetic than a lot of the Q&As that Pabrai has done with students and things like that. So just my 2 cents on that one, since many of you have asked. It's probably not the answer you wanted to hear, but that's my take on it. Hope to see more interviews with Pabrai from people more, not exactly on a peer level, but when there's so much distance, like if a student is interviewing Pabrai, it can lack some of that kind of back and forth and some of that charge with differences of opinion. So anyway, I'll leave it there, guys. Thanks for watching, and I'll see you all in the next one. Take care.